You're holding a lie in your hand right now. That sleek smartphone you can't live without, the one you checked 17 times before breakfast, contains something big tech desperately hopes you'll never think about. Inside that glass and aluminum shell sits roughly a quarter gram of silver, and Apple alone sold over 200 million iPhones last year. Do the math. That's 50,000 kilograms of silver just for iPhones, just for 1 year, and that's only the beginning. Google's data centers processing your searches, Tesla's electric vehicles promising a green future, the AI servers training ChatGPT, the solar panels governments are mandating on every rooftop, they all run on the same secret ingredient: silver. Not gold, not platinum. Silver. The most conductive metal on Earth, irreplaceable in electronics, and big tech is consuming it faster than miners can dig it out of the ground. But here's what should terrify you. While technology companies quietly absorb millions of ounces every month, the price barely moves. Someone is suppressing the signal. Someone benefits when you don't notice. And if you understood what's really happening beneath the surface of your screen, you'd never look at your iPhone the same way again. If you want to see what's really happening behind the headlines, behind the earnings calls and the polished keynote presentations, hit subscribe right now, because what we're about to uncover doesn't get talked about in mainstream financial media, and there's a reason for that. Let's start with something you need to understand about silver. This isn't just another commodity. This isn't wheat or copper or even gold. Silver is the single most indispensable material in modern electronics, and that's not marketing hype, that's physics. Silver conducts electricity better than any other element on the periodic table. It conducts heat better than any metal. It's antimicrobial, reflective, durable, and ductile enough to be drawn into wires thinner than a human hair. When engineers at Apple or Samsung or Google sit down to design the next generation of technology, they don't choose silver because they want to. They choose it because nothing else works as well. Nothing. Scientists have spent decades trying to find cheaper alternatives, and they've failed. You cannot build a modern smartphone without silver. You cannot manufacture high-efficiency solar panels without silver paste on the photovoltaic cells. You cannot construct AI server farms without silver in the circuitry, managing massive computational loads. Every 5G tower, every electric vehicle charging system, every smart home device, every medical imaging machine, they all depend on this one metal. And yet, most people think silver is just for jewelry and old coins your grandfather collected. Now here's where it gets interesting. Global silver mine production sits at around 800 million ounces per year. That sounds like a lot until you realize that industrial demand alone, just industry, no investment, no silverware, consumes over half of that. The Silver Institute reported that in 2023, industrial applications required approximately 550 million ounces. Smartphones account for roughly 50 to 60 million ounces annually. Photovoltaic solar panels consumed over 130 million ounces last year, and that number is growing at 15 to 20% per year as governments around the world mandate renewable energy transitions. Electric vehicles use anywhere from 25 to 50 grams of silver per car, depending on the model, and EV production is projected to hit 20 million vehicles per year by 2025. Every Tesla, every Rivian, every electric BMW drains the silver supply. Then you have the explosion in data centers. Google, Amazon, Microsoft, Meta, they're building server farms the size of small cities to power cloud computing and AI development. Each facility requires thousands of ounces of silver in electrical contacts, circuit boards, and thermal management systems. Add it all up, and the industrial consumption curve is nearly vertical, but consumption is only half the equation. Let's talk about supply, because this is where the story gets dark. Silver doesn't come from silver mines, not really. About 70% of global silver production is actually a byproduct of mining other metals, primarily zinc, lead, and copper. That means silver supply is tied to the economics of completely different commodities. When copper prices drop, mines shut down and silver production falls, even if silver prices are rising. Miners can't just turn on the silver tap when demand increases. The primary silver mines that do exist are facing declining ore grades, meaning they have to process more and more rock to extract the same amount of metal. Environmental regulations are tightening. Permitting timelines for new mines now stretch 10 to 15 years in developed countries. Major silver-producing nations like Mexico and Peru face political instability and resource nationalism. Mexico recently moved to ban open-pit mining. Peru has seen violent protests shut down major operations. And here's the kicker. There hasn't been a major new silver discovery of significant size in over a decade. The easy silver has already been found and extracted. What remains is deeper, lower grade, harder to reach, and more expensive to refine. So we have industrial demand growing exponentially, particularly from big tech's hunger for electronics, EVs, and renewable energy infrastructure, while supply growth is stagnant or even declining. Basic economics tells you what should happen next. Prices should explode. Silver should be trading at triple its current level, maybe more. But it's not. As of this moment, silver hovers around $25 per ounce, roughly the same inflation-adjusted price it was 40 years ago, despite industrial demand multiplying several times over. How is that possible? How can a critical material with surging demand and constrained supply remain so cheap? This is where we enter the realm of what big tech and major financial institutions would prefer you never question. The silver market is tiny compared to other financial markets. The total above-ground silver inventory available for investment in industry is worth maybe $40 billion globally. That's less than the market cap of many individual tech companies. Apple alone has more cash on its balance sheet than the entire investable silver market. This creates a vulnerability. A relatively small amount of capital can dramatically influence silver prices, and entities with deep pockets have enormous incentive to keep those prices suppressed. Why? Because every dollar increase in the silver price adds hundreds of millions to the manufacturing costs of companies like Apple, Google, Samsung, and Tesla. If silver hit $50 per ounce, suddenly the bill of materials for consumer electronics becomes uncomfortably expensive. Profit margins shrink. Shareholders ask questions. Executives miss bonus targets. So what do you do if you're a corporation that needs to purchase millions of ounces of silver every year? You hedge. You use derivatives, you work with banks to manage your exposure, and if you're sophisticated enough, you ensure that the futures market, where silver prices are discovered, remains under control. The silver futures market is dominated by a small number of players. For years, researchers and analysts have documented unusually large short positions held by a handful of banks, positions so massive they couldn't possibly represent actual commercial hedging. They represent something else entirely. These concentrated short positions have the effect of capping price rallies. And when physical buying pressure starts to push silver higher, a flood of paper contracts appears on the futures exchange, driving prices back down. It's been investigated. In 2020, JPMorgan was fined nearly $1 billion for spoofing precious metals markets, including silver, manipulating prices through fake orders. That's not conspiracy theory, that's documented legal settlement. The question is, if one bank was doing it and got caught, how many others are still doing it, just more carefully? Now think about the incentive structure. Big tech doesn't directly manipulate futures markets. They don't need to. They simply benefit from a system where banks and trading firms have every reason to keep silver prices low. Apple signs supply contracts with companies like Foxconn. Foxconn sources materials at market prices. If silver stays cheap, Apple's costs stay low, margins stay high, stock price stays elevated. The entire technology sector floats on an ocean of cheap silver, and nobody in Silicon Valley wants that ocean to drain. This creates an implicit alliance between technology manufacturers, the banks that finance them, and the traders who manage commodity exposure. It's not a conspiracy in a smoke-filled room, it's just aligned incentives operating in shadows most people never look into. Meanwhile, what's happening on the ground, in the real physical world? Silver inventories tracked by exchanges like the COMEX have been falling dramatically. In 2020, COMEX silver stocks stood around 400 million ounces. Today, they're below half that and declining. The London vaults that store silver for international markets have seen similar drawdowns. Physical silver is leaving the system, getting consumed in electronics that will never be recycled, embedded in solar panels sitting on rooftops for 25 years, sealed inside EV batteries that might eventually get recycled for lithium, but not for the grams of silver in the control systems. This is one-way consumption. That silver is gone, effectively removed from available supply forever. And yet the paper market, the futures and derivatives market where prices are set, trades hundreds of millions of ounces that don't physically exist, that are just contracts, just promises to deliver metal that may or may not be there when someone actually asks for it. This is the dirty secret. The price you see quoted for silver doesn't reflect physical reality. It reflects a paper market designed to facilitate hedging and speculation, but increasingly detached from actual supply and demand. Big tech benefits enormously from this arrangement because it keeps their input costs artificially low while they scale production to unprecedented levels. Think about Apple's trajectory. They've gone from selling millions of devices per year to hundreds of millions. Google's data center footprint has exploded. Tesla delivered over 1 million vehicles last year and plans to double that. Every expansion multiplies silver consumption, but the price signal that should ration a scarce resource and incentivize new production never appears because the paper market absorbs the pressure. So what happens when this breaks? Because it will break. Every market built on suppressed prices and financial engineering eventually faces a reckoning when physical reality reasserts itself. Imagine a scenario where just a few large institutions, maybe sovereign wealth funds, maybe a tech company that decides to secure supply directly, maybe even a coordinated group of wealthy individuals, start demanding physical delivery of silver against futures contracts. The COMEX has rules allowing for cash settlement when metal isn't available, but if enough pressure builds, If enough players call the bluff simultaneously, the system fractures. We saw a preview of this in early 2021 during the Reddit-driven silver squeeze attempt. Retail investors bought hundreds of millions of dollars in physical silver and SLV shares in a matter of days. Premiums on physical silver coins spiked to 40% above spot price. Dealers ran out of inventory. Mints couldn't keep up with demand. And the spot price barely budged because the futures market simply printed more paper contracts to suppress the rally. But that was retail money, unsophisticated and easily dismissed. What happens when institutional money, real money, shows up with the same idea? Let's talk about who wins and who loses when silver prices finally reflect reality. The winners are obvious. Mining companies sitting on silver reserves, investors who accumulated physical metal while it was cheap, countries with significant domestic silver production who can leverage it as strategic leverage. The losers? Consumers, first and foremost. If silver triples in price, your next iPhone costs more, your laptop costs more. Solar panel installations become more expensive, potentially slowing the renewable energy transition governments are desperately trying to accelerate. Electric vehicles, already expensive, become even less accessible. This creates a brutal dilemma for policymakers. They've mandated a technological transition to green energy and electric transportation that depends entirely on affordable silver, but the very success of that transition guarantees silver won't stay affordable. It's a trap, and big tech is caught in the middle, completely dependent on a material they have no control over and every incentive to keep cheap. But here's the deeper implication that almost nobody is discussing. Silver shortages don't just make gadgets more expensive, they could actually slow or halt technological progress in specific domains. If a solar panel manufacturer can't source enough silver, they can't produce panels, and the renewable energy build-out stalls. If an EV maker can't secure silver for charging infrastructure and battery management systems, production slows. If AI companies can't build new data centers because silver components are unavailable or prohibitively expensive, the AI revolution everyone's betting on hits a resource constraint. We're so focused on compute power, on algorithms, on software innovation, that we've completely ignored the material substrate all of it rests on. It's the same mistake civilizations have made throughout history, assuming that critical resources will always be available at reasonable prices, right up until they're not. And there's a geopolitical dimension here that makes this even more precarious. China controls a significant portion of global silver refining capacity. Mexico and Peru, major producers, have increasingly fraught relationships with Western governments and mining companies. Russia, despite sanctions, remains a notable silver producer. If global tensions escalate, if trade wars intensify, if resource nationalism spreads, silver supply chains could fragment. Imagine a scenario where China restricts silver exports to protect its own strategic industries. Suddenly, Apple and Tesla are competing with Chinese EV makers for limited supply. And guess who Beijing prioritizes? This isn't hypothetical fear-mongering. China has already restricted exports of gallium and germanium, critical materials for semiconductors, in response to Western tech restrictions. Silver could be next, and the impact would be catastrophic for Western tech companies. Now let's zoom out and look at the investment angle, because this is where individual people like you watching this, actually have agency. Sophisticated money has known about the silver situation for years. Warren Buffett famously bought 130 million ounces of silver in the late 1990s when it was under $5 per ounce. He sold it too early, around $7, but he understood the thesis. Critical industrial metal, limited supply, growing demand. That thesis is exponentially more compelling today. Demand from technology and green energy has multiplied several times over since Buffett's trade. Supply growth has stalled. Inventories are at multi-decade lows, and yet the price remains absurdly low by historical standards. Silver hit $50 per ounce in 1980 and again in 2011. Adjusted for inflation, the 1980 peak represents nearly $150 in today's money. We're talking about a metal trading at a fraction of its inflation-adjusted historical high, despite being far more critical to the global economy now than it was then. The opportunity is obvious, but so is the risk. Timing is impossible. The suppression mechanisms could persist for years. Financial markets can remain irrational longer than you can stay solvent, as Keynes famously observed. But the fundamentals are undeniable. At some point, physical scarcity will overwhelm paper manipulation. At some point, industrial users will panic about supply security and start hoarding. At some point, investors will recognize that silver is the most undervalued strategic material in the world. When that inflection point arrives, the move will be violent and sudden. We've seen it before in other commodities. Lithium was an obscure material until the EV boom, then prices went vertical. Palladium was cheap until emission standards tightened and automotive demand surged. Then it hit $3,000 per ounce. Silver's turn is coming, and the people who position themselves before the crowd realizes what's happening will capture generational returns. Here's what makes this particularly fascinating from a systemic perspective. Big tech has built an empire on the assumption of infinite cheap resources. Silicon, lithium, rare earths, and silver, all the materials that make the digital age possible, were treated as effectively unlimited. Mining capacity would scale with demand. Prices would remain stable. Supply chains would function smoothly. That assumption is breaking down across the board. We've already seen chip shortages disrupt auto production. We've seen lithium prices spike and crash. We've seen cobalt supply concentrated in politically unstable regions create ethical and logistical nightmares. Silver is the next domino, and it might be the most important one because, unlike lithium or cobalt, there is no substitute for silver in many of its critical applications. You can redesign a battery to use different chemistry. You can't redesign the laws of physics that make silver the best electrical conductor. So what does big tech do when they can no longer ignore the silver problem? They have a few options, none of them good. They can pay up, accepting higher costs and lower margins. They can hoard, securing long-term supply contracts, or even buying mines directly, which would send a signal to markets and potentially trigger the very price spike they're trying to avoid. They can invest heavily in recycling technology, trying to recover silver from old electronics. But e-waste recycling is expensive, logistically complex, and can't scale fast enough to meet current demand, let alone future growth. Or they can lobby governments to intervene, to somehow increase supply or restrict investment demand. But that's a political minefield with no guarantee of success. Every option is bad, and the longer they wait to act, the worse the options become. From your perspective, as someone watching this unfold, the question is, what do you do with this information? You could buy physical silver, coins, or bars, and hold them as insurance against technological supply shocks and monetary instability. You could invest in silver mining companies, leverage plays on the underlying metal price. You could trade silver futures, if you're sophisticated and well capitalized, though that's the same rigged casino we've been discussing. Or you could simply adjust your mental model of how the world works, recognizing that the technology you depend on rests on fragile material foundations that most people are completely blind to. That knowledge alone has value. It changes how you interpret news about chip shortages, EV production targets, renewable energy mandates. It gives you a framework for understanding why certain things that seem inevitable might not happen, or might happen very differently than expected. The broader lesson here is about hidden dependencies. Our civilization runs on invisible networks of materials, supply chains, and commodities that nobody thinks about until they break. Silver is one of the most critical and most overlooked. Big tech's dirty secret isn't that they're stealing your silver in some nefarious plot. It's that they've built trillion-dollar empires on a foundation of cheap silver that won't stay cheap. And when the price adjusts to reality, the entire technology sector faces a margin compression and supply crisis unlike anything we've seen. They know this. The executives and supply chain managers at Apple, Google, Tesla, they absolutely know this. They have people whose entire job is monitoring silver markets and securing supply. But they also know that publicly acknowledging the problem could trigger the very price spike they're trying to avoid. So they stay quiet, they hedge privately, and they hope that new supply somehow materializes or that breakthrough technologies reduce silver intensity before the crunch hits. But hope isn't a strategy, and breakthrough technologies don't appear on demand. The energy transition requires silver. The AI build-out requires silver. The smartphone upgrade cycle requires silver. These are locked-in demands, structural megatrends that aren't going away. And on the other side, mining supply faces structural constraints that aren't going away either. We're heading toward a collision between unstoppable demand growth and immovable supply limits, and silver prices are the variable that has to give. When they do, fortunes will be made by those who saw it coming and positioned accordingly, and fortunes will be lost by those who assumed the status quo would persist indefinitely. So the next time you pick up your iPhone or watch a presentation about the latest AI breakthrough, or see a politician promising millions of electric vehicles and solar panels, think about the silver. Think about the quarter gram in your phone multiplied by billions of devices. Think about the grams in every solar panel, every EV, every data center. Think about where all that silver comes from, how much is left, and who benefits from you not asking these questions. Big tech isn't stealing your silver in a literal sense. You never owned it to begin with. But they are consuming a finite strategic resource at an accelerating pace while prices remain artificially suppressed. And when the bill comes due, when scarcity finally forces prices to reality, the impact will ripple through every screen, every battery, every technology you take for granted. The game is already in motion. The pieces are on the board. Industrial consumption is surging. Inventories are falling. Mining supply is constrained. Financial suppression can't last forever. The only question is when the break happens and whether you'll recognize it when it does. Because this isn't just about silver prices or tech stocks or investment returns. This is about the material limits of our technological civilization. About what happens when exponential growth in digital domains collides with linear or declining growth in physical resources. We're living through the early stages of that collision right now. Most people have no idea it's even happening, but you do now. You understand what they don't want you to connect. You see the invisible foundation beneath the shiny surface. And once you see it, you can't unsee it. Every device, every innovation, every promise of a cleaner, smarter, more connected future, they all rest on the same scarce metal being quietly consumed faster than it can be replaced. Big tech built an empire on that assumption, and empires built on false assumptions don't tend to end well. Watch what happens next, because the silver story is just beginning and the final chapters are going to be extraordinary.